Ryan buys a rental property. Adam puts the same money into index funds. Both of them are convinced they made the smarter move. 20 years later, the numbers tell a very different story than either of them expected, and the gap isn't where you'd think. Let's start on equal footing. Ryan and Adam are both 29, both earn the same salary, and both have exactly $60,000 saved. The only thing that's different is what they do with it. Ryan puts his $60,000 down on a $280,000 rental property, a small duplex in a decent part of town. He finances the rest with a 30-year mortgage. His monthly payment lands around $1,400. He finds tenants willing to pay $2,000 a month combined. On a napkin. That's $600 a month in pure profit. Ryan feels like he just cracked the code. Adam takes his $60,000 and puts it straight into a low-cost index fund. No tenants, no property, no story to tell at a barbecue. He sets up an automatic monthly contribution of $350 and basically forgets the account exists. When people ask what he's investing in, he says, index funds, and the conversation usually ends there. Nobody's impressed. Nobody asks a follow-up question. Day 1, it isn't close. Ryan has keys, a tenant, and bragging rights. Adam has a confirmation email. But the first few years reveal something neither of them expected. Ryan is living the landlord experience in full. Rent hits his account, he watches the neighborhood's home values creep upward, and he deducts mortgage, interest and depreciation at tax time. It feels tangible. It feels smart. Adam, meanwhile, checks his account every few months and sees a number that's mildly higher than before. No excitement, no drama, just a slow, boring climb. By year 3, the real math starts showing up. Ryan's collected roughly $70,000 in rent, but after mortgage payments, property taxes, insurance, a broken water heater, a roof repair, and one frustrating month of vacancy between tenants, his actual pocketed profit is closer to $3,000 or $4,000, not the 20+ thousand the napkin math promised. And that's before counting a single hour of his own time spent managing tenants, fielding late-night maintenance calls, and coordinating repairs. Adam's index fund, meanwhile, has quietly grown from $60,000 to somewhere around $85,000, counting his contributions. 0 maintenance calls. 0 emergencies. 0 hours spent. But Ryan still has one card Adam doesn't leverage. His $280,000 property has appreciated to roughly $300,000. And because he only put down a fraction of that price himself, his actual equity has grown much faster percentage-wise than his original investment. That's the real power of real estate. It lets you control an asset worth far more than what you actually paid for it. By year 10, the picture gets more interesting. Ryan's property is worth somewhere around $370,000, and after paying down the mortgage for a decade, his equity sits around $190,000. Impressive on paper, but tally up everything he spent along the way: repairs, vacancies, insurance increases, a new HVAC system he didn't see coming, and his real out-of-pocket cost beyond the original down payment lands somewhere between $25,000 and $40,000. Adam's portfolio, with consistent contributions and average market growth, is sitting around $175,000. He put in roughly $90,000 total across 10 years. The rest is compounding, doing what compounding does slowly, then suddenly. At this point, they're close. Ryan might be slightly ahead, largely thanks to leverage. But he's also spent hundreds of hours managing a single asset in a single location, while Adam owns a tiny slice of thousands of companies and hasn't lost a night of sleep over any of it. This is where the story really splits. By year 20, Ryan's property has climbed to roughly $480,000, his mortgage is essentially paid off, and his equity sits somewhere between 420 and 450,000. Solid. But factor in 2 decades of repairs, tenant turnover, 1 major renovation, taxes, and insurance, and his actual net profit above what he put in is somewhere in the range of $50,000 to $90,000, a wide range depending on how kind the market and his tenants were to him. Adam's portfolio, still on autopilot the entire time, has grown to somewhere between $430,000 and $470,000. No debt. Number 2 AM phone calls about a leaking pipe. No single point of failure sitting in one zip code. Net worth-wise, they land in almost the same neighborhood. But how they got there couldn't be more different. Ryan worked for his number: stress, tenant issues. Concentrated risk, an asset he couldn't sell in an afternoon if he needed to. Adam waited for his market volatility, sure, but liquidity and total freedom. The entire way. And here's the detail that changes everything: if Adam had simply bumped his monthly contribution up by $200 early on, his 20-year total jumps dramatically higher, because in the market, more money in means more compounding, automatically. In real estate, scaling up usually means buying another property, taking on another mortgage, and doubling the workload all over again. None of this means real estate is a bad move, it isn't. In markets where rent genuinely covers the mortgage from day one, where someone treats it like an actual business instead of a hobby, or where strategies like house hacking are on the table, real estate can outperform the market significantly, leverage included. And the tax advantages available to property owners are something stock investors simply don't have access to. But stocks aren't the safe, boring backup plan people assume either. Markets can drop 30+% in weeks, and most people panic and sell at exactly the wrong moment, locking in losses that patience alone would have erased. There's no monthly rent check landing in your account either, just a number that occasionally does something uncomfortable before it eventually keeps climbing. Ryan and Adam both walked away from their 29-year-old selves convinced they'd found the smarter path. Neither of them sat down and mapped out the full picture, the time, the stress, the hidden costs, the real risk before making the call. And that's really the trap underneath this entire debate. It was never real estate versus stocks. It was always about whether you actually ran the numbers for your own situation, or just followed whatever sounded convincing at the time. So next time someone tells you one of these always wins, ask them a simple question: did you count everything? Because the only answer worth trusting is the one that does.